Welcome everyone to the next Market Matters. This is September 1st, 2020. My name is Todd Jones. I'm the Director of Investments for Gratus Capital. Thanks for taking the time to join us today. Before we get started, I did want to kick off with a few housekeeping items. One is that, as per usual, if you have any questions along the way, please feel free to drop those into the chat feature of Zoom. When I grab those in the chat feature, I'll be able to maybe address them as we go. So hopefully, if anything comes to mind, you all are able to drop those questions in a timely manner, and we'll get them through the end of the discussion today. This is our first Market Matters we've done in 2 weeks, and just a reminder, this Market Matters series will now be a monthly series, and that will conduct the first Tuesday of every month. And we think that dovetails nicely with some of the other content that we're going to be bringing out, or we just started bringing out, and that is the weekly edition of 2 Minutes with Todd that's due to come out every Monday. Can be found wherever podcasts are found, where you subscribe to your podcast typically. But that's a nice, short, and abbreviated 2 minutes where we review what's went on last week, what's coming up for the week to follow, and any investment considerations that might be timely. So we hope you enjoy that. And as always, if there's any feedback, please feel free to give me that, because that's the way we make this stuff better. So ultimately, we want to provide you the most relevant information in the most timely way possible. Let's review the quick agenda. And the agenda does follow a similar format that we have in previous periods or previous weeks. We'll review a COVID-19 update. Obviously, that's still going and has definitely important implications. Economic and investment updates that may be coming out of some of what we're experiencing recently, not only from the markets, but also data being coming out about the economy, and then also a little bit about the November elections and some considerations we're keeping in mind for that. So first, let's turn to the COVID-19 update. And I think it's important to just review a similar data set, so we all have a frame of reference, or in the case, if you wanted to go back and review, you're able to do that as well. But I mean, I think you can see here, one of the key takeaways on a global basis is that, global cases continue to level out, some regions rising, some regions falling. But, previously contained areas are now starting to have their second wave, particularly on this chart, Germany, but also more importantly, in places like Spain that are having a pretty big resurgence in some of the touristy areas. But that does help give us a baseline that globally, I think more importantly, yes, regions are having different experiences with COVID, but it does appear to be leveling off. So that's, I think, a supportive underpinning for financial markets for sure. I haven't shown this chart in a little while, but this is, I think, specific to the US situation. And it does, I think, help give a picture for, the testing improvements that have been made since March. I mean, come a substantial way from virtually nothing back in March to about 700,000 tests per day. But the key metric here, of course, is the percent of those tests that are positive. And, obviously a decline in percent positive should help everyone sleep a little easier at night, that, municipalities or government organizations are taking this seriously. Businesses like ours are taking this seriously, and that, a trend lower will ultimately help us buy us time to find a vaccine, because ultimately I think that's going to be the only solution to this problem, is that not dissimilar to, polio or other afflictions that have come up over the years. The one way to do away with this would be to find a vaccine. And that's clearly, I think, just what the market is pricing in right now. And there's good reason for that, because again, this is a similar data series that comes off of the New York Times website. And, it's hard to underscore the rapid progress that's being made in vaccine development. And I think it's important also to note that the head of the FDA just a couple of days ago reiterated the idea that there will not be a vaccine approved for full use without a full scientific evaluation. I know that some people have been a little leery about vaccine development and the rapid phase trials or testing that's been going on to speed things through the phases 1, 2, and 3. But I think it's comforting to hear that the appropriate science will be applied to this affliction. And as it turns out, phase 3 trials, this is the stage right before a drug is approved for full use or limited use by the FDA. we now have 2 more vaccines in stage 3 than we did 2 weeks ago. And recall that was 7. And recall that 2 weeks prior to that, we had only 5. So I think, advancement within the science is increasing at a pretty rapid rate. And that certainly, I think, is helpful to getting the market comfortable with where we are from, levels that they're trading at right now. So now let's take a look at the economic and investment updates. So there has been one update, I think, that we've made since the last time we did this 2 weeks ago, this Market Matters, and that is an upgrade right here in the bond segment of emerging market debt. Now, obviously, we're not rushing out to buy emerging market debt. Really, this is more just a affirmation that a declining US dollar not only is helpful for international stocks, particularly developed market and emerging market stocks, which we upgraded on the weakening dollar, but also now bond prices, particularly if either whether they're priced in local currency or not, a declining dollar is usually a good thing from a budgetary standpoint for emerging markets, just because it means it's less US dollar liquidity they have to come up with to service debt, particularly if that debt was issued in US dollars. Now, and again, whether this will make its way into our portfolio, it's really a measuring game of, how attractive is this asset category versus everything else that we've got out there. Currently, it's not in any portfolios, but we are upgrading it from a very unattractive to maybe a neutral weighting. And just some general notes here, continuing to, as I mentioned in the last few weeks, we're continuing to add to our, what I'm calling our dry powder position. This is an ultra short term ETF, bond ETF. That's really going to be used to draw on when the market decides to get a little sideways in the future. We don't know exactly that'll mean, or when that will be, but it's going to be there to help us take action, just like we did in March of this year with that same position. And I just wanted to make note here, reiterate, the markets does appear to be pricing in a vaccine in late 2020, early 2021. Again, can't use any specificity here, but that certainly would, I think the market action would certainly indicate that we will have a vaccine sometime in the next 6 to 9 months. On the U.S. equity side, on the equity side, U.S. dollar falling is a key reason to consider international equities again. As you know, we've upgraded that category to an overweight, in some cases, or positive neutral, and starting to add that back to accounts where appropriate. We're adjusting our core equity strategy to reflect, this is now maybe a little bit of a research pivot here, but I did want to mention it that, we are adjusting our definition of value. And so there's a lot of economic research been written on, what defines a value-oriented security. A lot of the research would suggest it's a low price to earnings multiple or a low price to book multiple. But our definition, and based on our research, would suggest that dividend growth is actually one of the best value indicators. If a company is able and willing to pay a dividend through a variety of financial or economic conditions, that reflects the stability in the name much better than a low price to earnings or multiple or PE or price to book, because that could also be an indicator of a value trap. Very rare do you find a dividend growth company being a value trap. Next, I did want to mention that our just to keep it out in front of everybody, our next rebalance target. And I know some people in the chat feature, when I did this last time, saw this level and thought it was a little crazy, but we're still targeting 3,600 on the upside for our next rebalance point. Again, whether we'll get there or not is a question, but I would certainly say that momentum is a very powerful force in the market right now, and there is, a possibility we can get there pretty easily or quickly. And then 2650 on the downside would be our next rebalance point. Those are, just by way of reference, those are roughly one standard deviation move up and down from current levels. So roughly 17% up from here, 17% down from here. Fixed income wise, yields continue to anticipate, I think, more quantitative easing. So yields are, which means in my mind, yields will likely head lower or stay here for the foreseeable future. The Federal Reserve, importantly, Jay Powell noted last week that they are changing the way they're going to be measuring inflation. They're using, instead of an explicit target of 2%, they're now moving to an average inflation rate, which sounds subtle, but it's actually really important, because what it means is they're going to let inflation rise above 2% and stay there for a period of time, as opposed to getting the 2% and then calling it a day. So to my mind, that means there's going to be, again, more support for the markets via QE and low interest rates. And again, our contention still remains that we're going to have low yields now, or lower yields now in bonds, but higher yields later once that inflation does start to creep in. And I'll talk about why that's so important in just a moment. And then finally, for those of us, or for those portfolios that are seeking income, I do think, portfolio or alternative strategies, whether they be public via mutual funds or private, being limited partnerships or private equity, are going to make up a larger portion of income generation for the foreseeable future until rates finally normalize to a historical rate. So I think it is important also to calibrate expectations on equities from here, from the point where we're at right now. Because valuations will certainly be a limiting factor on the upside. Not to say that we can't experience positive returns, but at the same time, we should just calibrate the expectations. So I just wanted to provide you some data as to why we're thinking a certain way. So as this chart shows, over the last 30 years or so, stocks on a rolling, I think it's a rolling 3-year basis, have only generated, believe it or not, roughly 4% more than bonds over this time period. Now, of course, in some periods it's higher, in some periods it's lower, but on average it's 4%. So if we've got a bond market that's going to be returning us very low rates of return, somewhere in that 50 basis points to 1% per year for the next few years, then by extension, stocks should be somewhere in the neighborhood of 5 to maybe 6% potentially. Now, that's at the index level. Those of us that are applying an active approach, and this is what gives me hope, those of us that are applying an active approach stand to, I think, have much better experiences than this average. But it's important to understand kind of the way forward, at least from an index or average standpoint. And as just to give you some insight, all those listening, we will be posting, starting in January 2021, our capital market forecasts for the next 5 to 7 years, because of course that's really important from a financial planning perspective to make sure we're putting in the right return numbers. So we're going to publish those so you all can see what we're talking about and why we're thinking a certain way for you to view it up in January. So be looking for that. On a equities perspective, where are we finding opportunities? Again, I'll circle back to the international stocks as being somewhere that we should be considering, at least maybe in a slightly larger stance relative to prior periods. And I think this really just tells a real big story as to why we would want to consider international right now. So I do have an update. This particular data point was through June. The data point through I believe it's July. And maybe let me orient you to this before I explain it. So what this shows you is going back to 1996, that's the left-hand side of the scale, to 2020, June of 2020. And then you take a measure of valuation across 3 very pedestrian or very well-known metrics: price to earnings multiple, price to book, and price to cash flow. And if you were to average those together, and compare U.S. stocks versus international stocks in general, that's the All Country World Index ex-U.S. So what would the relative premium or discount be to the U.S. stock market from an international perspective? So back in '96, what you're seeing here is that international stocks traded at roughly on par with U.S. stocks. And that's actually migrated all the way down to, believe it or not, roughly a 40% discount to U.S. stocks on these basic metrics. So long story short here is that valuation attractiveness in international stocks is getting hard to ignore. And that's especially important when you consider that the U.S. dollar is now and has been weakening for the better part of the last 6 months. So you have a double tailwind, essentially. This is a staggering stat that I would just kind of say would reinforce what I was talking about on the prior slide. And would you believe it or not, the average international stock outside the U.S. has performed exactly the same as the average U.S. stock here in the U.S. So the way you measure that is you take an equal weighted approach to those indexes, as you may be familiar, the S&P is a market cap weighted index, which means that the largest companies will comprise the highest weightings. So for example, Apple in the US is comprising somewhere between 5 and a 6% weighting in the S&P 500. If you were to equal weight the S&P, meaning every position it would have the same weighting, then you're down to Apple making up only 25 or 30 basis points of the index. And so what it's saying is that two things. One is that the largest US companies are skewing performance for the US, and it's certainly important to keep that in mind because we identified that a little bit earlier in the year. But also international stocks haven't performed nearly as poorly as maybe some people have thought they would. So just wanted to make sure that was pointed out because it's a key reason to consider international companies. And this is just the same performance view that I've showed in prior periods that is just worth revisiting. This is the year-to-date performance of equity markets through last Friday. So you have the large US companies, that's the S&P 500, up somewhere between 9.5%, 9.5% if you include dividends. Emerging market stocks, interestingly, have now broken or gone positive for the year at +2. And developed international stocks still negative at -5% or so. And small companies still lagging almost every other category with a -5.5% or so. And, again, keep in mind that these were, we have no exposure to US small cap stocks in our benchmark strategies or the dividend strategy for that matter. We just added an emerging market position to our dividend or to our benchmark strategy. And we upgraded international stocks back in, I think it was June or so. So we see good times ahead for international. On fixed income, that continues to be a bit more of a tricky situation to parse out because rates can only go so low. And as I mentioned some of my opening remarks, some of the Federal Reserve's activities in March had a very stabilizing effect for the bond market. But from here, it doesn't appear that there's much more juice to squeeze, if you will, out of domestic bond markets. Yes, they will provide you a modest amount of income in some cases. Yes, there will be some capital preservation benefits to the fixed income holdings right now. But that's why we're considering or looking at things like emerging market bonds right now as potential additions, because they, in some cases, have the same credit quality, believe it or not, as most developed markets do, with an A or AA potentially, but also their yields are just far higher than anywhere else, really, developed or US. Junk bonds or high yield bonds, I do hear a lot of people talking about how this is a great place to be right now, not dissimilar to emerging markets, because the Fed is going to support the interest rate complex. And I just, have a hard time believing that a poor company isn't at some point going to find itself in default if it's not being run appropriately. So if it's a questionable credit quality, especially in the kind of market we're in right now, I think it's just safer to steer away from some of the lower quality fixed income investments right now. That would also include things like preferred stock or some commercial mortgage-backed securities for that matter. And I did want to touch on inflation, because inflation is one of the critical variables that helps the bond market set their price for what yield we all receive. And also it impacts every one of our lives, right? I mean, I'm sure all of us have experienced some of the dramatic rise in medical premiums or tuition rates over the last 20 years. But as it applies to the equity markets, I think it's really important to understand this relationship. So I know there's a lot going on this chart, so I'll slow it down here just for a moment. So this is a chart that starts in 1900, going all the way to I think it's 2015, if I'm not mistaken. It cuts off right here a little bit, but I think these data series do tell a really important story. The blue line is the measure the government uses to measure inflation. It's called the Consumer Price Index. And yes, the methodology for Consumer Price Index has changed a couple times over the years of its existence, but it's the one kind of true measure we have right now. So we'll just go with that for right now. The other item I wanted to touch on here, though, is the PE multiple, the PE ratio, and that's here on this right-hand axis. So you can see stocks back in 1920 traded at a PE ratio of five times earnings. You can see it got all the way up to 26 times earnings back in 1929. Back in the dot-com bubble, 2000, it got all the way up to 42 times earnings, and then kind of migrated lower as we got further into the recovery mode back into 2008, right around here. So what this relationship essentially says is that the higher inflation gets, the lower PE multiples will tend to get over time. Now, certainly it's not a direct correlation. So a 15% inflation reading does not equate to a 5 times price to earnings multiple. And that would certainly bear itself out here over these other two observation periods. But what it does say is that when inflation gets to a high point, you all may remember the inflation of the 1970s, which I'm kind of templating some of what's to come in the bond market in the next couple of years or so, potentially, is that if inflation does reach above, let's say, a 10% level or more, that means that bond yields that are coming out new to the market must be priced at least 10% or higher, because every bond price or every bond yield has an inflation premium attached to it. So, recall back in 1980, I was alive then. So not that I remember those days, but I still remember my parents talking about their mortgage rate back they had on their first house. And I think the mortgage rate they had at that time was 15% or so. And that's a rough approximation of what the bond market was at that time as well, too. 10-year government bonds in 1980 were 15% or so. 30-year government bonds, I believe, were in that 17% range. So inflation drives bond yields up, and that creates competition for equities, because if you can get 17% on your bonds, then that represents real competition for equities. And so then you have to price equities at a lower multiple to attract buyers, if that makes sense. So this is why we paid so much close attention to inflation, and why the Fed is paying so much attention to inflation. Because if inflation gets to a high enough point, then it's going to mean that equity markets should trade a lot lower. So I guess the net of it is we're watching for inflation. So where would we see that? Well, you can see it in some market indicators, because remember, consumer price index reports with a lag. So prices you're experiencing now won't show up in the data for another month or two. But where you can see it real time is in the difference in the U.S. Treasury inflation protected bond prices or yields versus the Treasury market or the U.S. aggregate bond market index. And so what you're seeing here is that, typically in low inflation environments, these indexes will trade very closely, but look what's happened recently. They've started to separate a little bit. I'm not so certain that this is going to be the death knell for the bond market, because I think inflation coming through right now really more relates to some of the commodity price inflation we've seen recently that's probably going to taper off over time, and some of the money that's been poured into the economy by both the Federal Reserve and also the government through stimulus checks. So let's move on here for the other item, which is now it is starting to show up in commodity prices, as I mentioned. And this is a good example of where it's starting to come in, but this really isn't something to be too worried about. It's just worth noting because there are certainly areas of the economy that are experiencing inflation. What you're seeing here on the screen is a chart of lumber prices. So lumber prices are measured dollars per, I think it's random length board pallet. And what you're seeing here is that prior to the COVID crisis, lumber prices were somewhere in the neighborhood of $300 per pallet, I think is the measurement unit. Now they're at 900, so almost a 3x increase. And this may say, well, you may say, well, wow, this is really crazy. Isn't this a representation of inflation? I would say yes, but it really has a lot more to do with the supply-demand dynamics, not only supply of wood, meaning that you may recall there's been a couple of really nasty forest fires out in California, but also in the Pacific Northwest, up into Canada recently, and that's taken stock of boards off the market that would previously have been there. But also interesting, read through is that COVID is now, because of all the remote working that's going on, and I could point to plenty of examples in my own personal network, but there is evidence to suggest that there are a number of people that are moving out of cities and into suburban areas because they can remote work, because there's not a real burning need to be as close to the home office as there once may have been. So that's creating, that's one reason why I think housing has been supportive recently. You may have seen the housing price index from Case-Shiller is somewhere in the neighborhood of +4 on a year-over-year basis. And so, not only is volumes of transactions on housing, single family housing, rising because people are moving to different locations, but also you've got, building activity that's starting to kick up as well too from builders, even though consumer sentiment has drifted off a little bit. So anyway, this is an example of inflation, but it's not necessarily something that we think will be too widespread. It's pretty isolated for the moment. And I just thought it was interesting and worth noting that this was a indirect beneficiary of COVID, as it turns out. So let's turn to the November election considerations. Now we still are, in September. November is a few months out still. So we don't want to make any dramatic adjustments quite yet. And so as I did, I think at the beginning of the year, when we started talking about this, just share some thoughts about how we're thinking about the election and maybe some probabilities around who might win and how that might be impactful. So as of now, as opposed to in January and February, Joe Biden is now the front runner by a fairly decent margin, although these are betting markets. This is a great website you can go to. It's called predictit.org. It's a betting website that came out of some of the relaxation of the gambling laws a few years ago. But Joe Biden is in the light blue. His chances or odds have peaked, it looks like, in mid-July and now have tapered off a little bit. Donald Trump earlier in the year was at a +60. I think over here in January he troughed at about a 35, and now he's rising again in the polls. And I think it's setting up to be a very contentious election, no question about it. The mail-in ballots will be a big point of pivot for both Democrats and Republicans. But each outcome may have its own unique set of circumstances. So in the case of Donald Trump winning, I think maybe one beneficiary of a Trump win would be a policy prescription that Trump has always wanted since the first term, which is the infrastructure sector. So infrastructure sectors, meaning things like, road companies, bridge companies, pipeline companies potentially, would all stand to benefit, I think, from accelerated approval process, but also significant reinvestment in our infrastructure as a country. So rebuilding airports, roads, toll roads, bridges, things of that nature. And in the case of Joe Biden winning, really difficult to really figure out which sector in particular. I mean, certainly there's going to be winners and losers, but I think on the losing side, potentially, he's talked a lot about raising corporate tax rates back up to a level in between where they were before Donald Trump and where they are now. So certainly the stock market may be impacted a little bit with higher corporate tax rates. Certainly, I think medical companies like drug companies have started to price in, a furtherance of Obamacare in a greater way. And so these are just some of the considerations we're looking at right now. And then finally, just to leave you with, an interesting slide here. I think Donald Trump has rightly recognized that a healthy stock market is a big influential dynamic in a lot of people's lives, particularly for those who are likely to vote, not unlikely voters, but likely voters. And what is all the data telling us? If the stock market is up in the time from July 31st to October 31st of any election year that has been measured since 1948, Does the incumbent party win the White House? And the answer is 72% of the time, that is the case. So those are pretty good odds. Now, and again, if the stock market does decide to crash before or correct before November, maybe his chances go down. But I think what this data says here is that if the stock market is still doing well by November, then Donald Trump will likely be the winner, just based on the data here. We'll see what actually happens. So just want to leave you all some key takeaways. We're at about the 30-minute or so mark, so I want to make sure we're being mindful of your time, and I'll pivot on here to questions. So first item here, equity markets are set to generate lower but still positive returns over the next 10 years, punctuated by sharp sell-offs. So there will be a keen need to remain flexible. So that means always having on hand some dry powder or some cash equivalents to draw on for when certain segments of the market give you opportunities. And we saw that, of course, earlier this year. Tactical rebalancing, meaning that you're making smaller adjustments to a portfolio, is the right answer to help reduce risk. One example of that we've done recently is trimming back some of the growth-oriented positions in our strategy and adding to more of the core value positions in our strategy, and or raising cash with some of that capital. But volatility between these asset categories creates opportunities. So again, try to take advantage of that when you can. Dollar weakness will likely continue, I think, as more and more comes out, as particularly if Joe Biden gets elected. The furtherance of some of these really massive entitlement programs will create some budgetary pressure potentially, and also some need to issue a lot more bonds. So if that's going to be the case, then this will be a key catalyst for adding to international stock positions. And again, just wanted to reiterate, we don't know exactly when, but it's likely lower yields for now and higher yields later. And the catalyst for that is when inflation starts to show up. Interestingly, though, when inflation does show up, I didn't mention it in my earlier comments, but one of the key sectors that would also benefit from inflation is the more cyclical parts of the economy. And that would actually be the quote unquote value sector. So the financial sector, like the banks, commodity producers, particularly like ExxonMobil or Chevron, some of those names, some of the manufacturing sector like 3M, those have all not done very well this year, but those all stand to benefit pretty greatly if inflation does show up. With that, I think that takes us to the end of our time. So I do thank you for your time on Market Matters and joining us today. Our next one will be the first week of October on the first Tuesday. So be looking for an invitation to that. Also, do check out the 2 Minutes with Todd wherever you get podcasts. And we look forward to updating you at some point here in the near future. And have a great rest of your summer. Thanks.